Welcome to a new deep dive on process protocol. Today, we're uncovering the real mechanics of the traditional banking system. Most people rely on traditional banking, but the core process behind modern money creation is often misunderstood. It's far more complex than simple storage. If you've been exploring alternative wealth like silver stacking, understanding this conventional system is crucial for contrast and context. The core misconception? Many think banks take your deposits, lock them away in a vault, and lend out only that existing money. This is wrong. The foundation of this system, used worldwide, is fractional reserve banking. This is where the magic or the complexity happens. It means the bank keeps only a fraction of your deposit as reserves. The majority is available to be lent out. For instance, you deposit 1,000 euros. Historically, banks kept 3 to 10%. The rest, over 900 euros, is then available for lending. Although required reserves are often zero today, banks still hold reserves for liquidity. Here's the mind-blowing part that official central banks confirm. When a bank makes a loan, it creates new money, almost, quote, out of thin air. Official sources, like the Bank of England, confirm that when a bank approves a loan, it doesn't transfer existing money from another account. When you get that 10,000 euro car loan, the bank simply credits your account with 10,000 euros. This new deposit is created immediately and recorded as a loan asset on the bank's books. This is how commercial banks create about 97% of the broad money supply. New money enters the economy as bank deposits generated by issuing loans. This process then leads to the multiplier effect, where the initial loan expands the money supply across the economy. When you spend that 10,000 euros, the seller deposits it into their bank. That bank can then lend out most of that new deposit, repeating the cycle and multiplying the money in circulation. However, there are limits to this creation: risk of bad loans, regulations like Basel III capital requirements, and central bank interest rates influencing lending demand. So why operate this system? The primary goal is to fuel economic growth and investment. More loans mean more investment, more homes built, and more businesses starting, driving expansion throughout the economy. The risks are significant: bank runs, inflation if there's overlending, and major financial crises like the one in 2008, which exposed the dangers of excessive leverage. The shocking truth is that commercial banks, not central banks printing cash, are the primary creators of the money we use daily. Even with the rise of digital payments, fintech, and open banking in 2026, the core process of endogenous money creation remains the foundation of our financial world. Banks profit significantly from the interest spread, the difference between the interest they charge on loans and what they pay on deposits, and by creating the money in the first place. Is fractional reserve necessary for growth, or would you prefer a full reserve banking system where 100% of deposits are backed? Let us know in the comments below.